Guys. How's everybody doing? Good? Quiet?
Good.
How was your break?
I don't know. The same old, same old.
I know, right? It's nothing interesting.
How was yours?
Not as productive as I should have been. Richard, I think you have to unmute yourself, so speak now. Richard?
Yeah, I'm here. I hear you.
Perfect.
Can you hear me?
Yeah, I can mute you or you can unmute yourself too.
Alright.
Yeah, I should have been more productive, but I feel like being home, you're a lot less productive these days. Oops, sorry about that. Okay. You guys have any questions for me before we start? I'll say that's a no. How is the internet connection on my end?
It's good.
Okay.
It's pretty good so far.
I have an extender and it was fine for the majority of the last class, but the very end, I think that more people were on the internet around here, so it slowed down a little bit. So hoping we don't have any issues. Everybody's so quiet today. Oops. How are you, Nika? Anybody watching any good shows?
I want to get into the Tiger King. I heard it was good, but I'm not sure.
I know. I haven't started it yet, but I keep hearing the same thing.
Yeah.
I heard
like my sister already spoiled it for me, so I'm like, is it worth it?
Yeah, that's never a fun thing. I was rewatching Downton Abbey.
Ooh, that's the British one, yeah.
Yeah. It's actually, I don't usually like period pieces, but for whatever reason, like those ones I like. They're kind of interesting. Some of it, I'm like, whoa, sorry about that. I don't understand the terms that they use sometimes because British terms are so different.
Oh yeah, it's almost like sometimes they're speaking a different language.
Seriously, British English is a way different beast. At least it's not raining right now. Thought it was going to be raining.
I know, it was pouring last night.
I know. As soon as I saw the weather, I was like, "Are you kidding me? How are we going to have another 5 days of rain? Like in San Diego, of all places, during our quarantine."
Yeah, it's supposed to rain all week, right?
Yeah. So I'm like, and I'm trapped inside of a house with a 3-year-old. Like parents' worst nightmare. Do you have any questions on the homework or anything? Anyone?
I've only done part of it, if I'm being honest. So, not yet.
That's fine.
Yeah, I've only done the pre-assignment. No questions so far.
Okay, good.
Um,
That's not here.
Sorry, I'm waiting until 12:45.
Hear me?
Richard?
Yeah, I can't. I only see you on a little screen.
Oh, on the little screen?
Yeah.
Yeah, because I have it on. I'm sharing my screen with you guys.
You ever watch Ozark?
Ozark? Yes. I need to rewatch the first few episodes of season 3, though.
it's really good.
That's pretty good.
I know, but you have to like pay attention to it, you know? And I was kind of watching it while doing other things.
So did you watch the last episode?
Oh, no. I have not watched the last episode. I heard it was a big one.
I'm not going to tell you.
Okay, please don't.
They-
Wait, there's a season 3?
Yeah, it just came out like last week or 2
Yep.
weeks ago.
Oh, I need to watch that.
Yeah, you have to make sure you include it on your list of Netflix
You
so that
fucking-
you
okay.
get the notice of it.
That's so true. Maybe I did get the notice and I was like not paying attention.
Well, and then it started. They started like filtering other things, like the top 10.
Yeah.
They keep changing it up on you. But I do like my Netflix. I think they provide better like TV quality stuff than Hulu does, because Hulu doesn't give you the full like past seasons, so you can't catch up or unless you've like watched it in previous years. You guys are not going to talk to me. I'm tired.
So wait, did you get my email?
When did you send it?
Just a little while ago in Canvas?
No, I didn't, because I haven't checked it yet.
Okay,
I checked emails before 10, but anything sent after that I didn't check.
okay, cool.
Sorry, I'll respond
No,
to it.
that's okay. That's all right.
If you see my email and ask where the postings are for the last tutorial, I found them.
Yeah, I just posted them. That was a really fun experience trying to upload, because I first have to convert it. And so the conversion, it has to go, I had 8 recordings I had to convert for both of my classes. And I thought that by clicking it once, like all of them would go, but no, you have to wait until the last conversion gets converted. So it kept taking forever. And then when I uploaded it into YouTube, it wasn't working. But it finally, I got all 8 uploaded for it, everybody. Your class had 4, sorry. This today, fingers crossed, the internet's strong enough and we only have 1 video and I'll upload it tonight.
That would be nice, but I won't count on
Yeah.
it. Internet sucks.
Ugh. Yes. Where's your class? We're missing a lot of people.
Maybe they're still on spring break.
No, that's what my fear was. It's not like we're traveling anywhere.
It's my
What? Different than being in class. I'm like sitting here staring at a screen by myself. You guys all saw the announcement that all summer classes are going to be online, right?
Oh, they are.
I did
Yeah.
not.
Yeah. So make sure that you're following the district and then our Mesa College on Twitter or Instagram or no, Facebook, whatever it is. Because that's how they're updating people the best. But all of our summer classes are going to be online only, just so that we don't have any like scrambling at the last minute to convert classes like we did this spring. And they haven't said anything about fall yet. Are you guys okay if I wait another minute just as people trickle in?
Sure.
Okay.
Is there a handout that goes with this chapter?
This chapter, no, there is not.
What?
I'll mute you.
Professor Wade, this is the handout that you posted.
Okay, sorry. Yes, there was a count. Guys, that was 2 weeks ago. I forgot already.
Right, it seems like a year ago.
Yes. Like, I'm sorry. Yes, there was a handout, Richard. It's where the original, I think, Zoom was posted, right? Okay. It's the same chapter. All of the scenarios and stuff, you guys don't have to write it down. You can take a screenshot of it if you want to, or you can just look at the PowerPoints once I post them. You guys ready?
Yep.
Okay. Do you guys want me to go kind of over a review of anything? So we're going through the cost, volume, profit chapter, and we're doing the analysis and kind of looking at if something changes, if we change the number of units that we sell, or if we change the selling price, or the variable costs, or fixed costs, what's going to be the impact on the company's bottom line? So is operating income going to increase or decrease? And when we're doing the analysis, we can take the income statement approach and actually recreate income statements, or we can take an incremental approach where we're just focusing on changes. The important thing to remember with the cost, volume, profit analysis is that variable expenses on a per unit basis are constant. So they're always going to be $300 per unit unless it changes within the scenario. Variable expenses in total are going to increase and decrease in direct proportion to changes in sales volume level, right? So if we sell more units, then we're going to incur more variable expenses in total. If we sell less units, we're going to incur less variable expenses. Same thing goes for sales revenue. If we sell more units, our total sales revenue is going to increase. If we sell less units, it decreases. And contribution margin is going to follow that same pattern. For every unit that we sell, we're going to earn $200 per unit under the original set of information. Fixed expenses, what do we know about fixed expenses?
They decrease as volume increases.
Yeah, so you can't and you shouldn't really put fixed expenses on a per unit basis in a CVP analysis. For the cost volume profit analysis, we really want to think of them as total, right? Because total fixed expenses remain constant. They don't change unless an outside factor changes it. So for this company, given this information, they will always incur $80,000 in fixed expenses unless they change their fixed expenses somehow. So we're going to look at scenario 3, which is a change in fixed costs, sales price, and then volume. So what is the profit impact if RBC cuts its selling price by $20 per unit? It increases its advertising budget by $15,000 per month. And in return, it's going to increase sales from 500 to 650 units per month. So in this scenario, what's happening? We're going to have an increase in sales volume, right?
An increase in variable expenses.
Variable expenses or fixed expenses? So advertising is what type of an expense? And
That's selling and admin.
this is the part that's key. It's not stated on a per unit basis, it's stated on a per month. So it's a fixed expense. And then we're going to also cut its selling price. So the selling price per unit is going to decrease. So if I go over here, this is the original information, right? And I'm just going to move this. I forgot to do that. So currently they have a selling price of $500, variable expenses per unit of $300, and then contribution margin of $200 per unit. Can I say that that's going to be the same under the second scenario, or sorry, under this scenario? Is the per unit information still the same? Is the selling price still 500?
No, it's $650 or $20.
Yes, it's a decrease of $20. So it's going to go from 500 per unit to 480 per unit, right? Decrease of 20. That 650 is the new volume. For the variable expenses, do we have any change?
No.
No. So it's still going to be 300. By default, because because the selling price changed and you didn't have an equivalent change to variable expenses, then contribution margin is going to change. Selling price decreased, so you're going to see an equal decrease to contribution margin. So 480 minus 300 instead of earning $200 per unit sold to cover those fixed expenses and to earn profit, now we're only going to earn $180 per unit sold to cover fixed expenses and create a profit. So we're going to see a reduction there. Do you want to do the incremental approach first, or do you want me to do the income statement first?
Let's do income statement first.
Okay. So write out that income statement again. So you're going to have your original set of information. So sales revenue, variable expenses, contribution margin, fixed expenses, and then operating income. So under the original, what we currently have, we're selling 500 units, right? And we have 250,000 in sales revenue, 150,000 in variable expenses, 100,000 in contribution margin, and then 80,000 in fixed expenses. So currently they have 20,000 in operating income. And we're going to compare that to the proposal. So scenario 3. How many units are we saying that they're going to sell under scenario 3?
Uh, 650.
650. So we know that we're going to look at that change column 2, right? For sales revenue for scenario 3, how am I figuring that out? What's the calculation? I'll put it over here. $650 units sold times what?
The new selling price.
The new selling price. So the new selling price is $20 less than the old selling price. So $480 per unit. So under this new scenario, we have an increase in volume by 150 units, but a reduced selling price. So the new sales revenue that we're expecting is what?
$312.
Yeah, 312,000, which is going to be an increase of $62,000. So the difference between 250, what we currently have, and the 312. For variable expenses, can I just take the 150 and carry it over?
Yes.
No. Thank you for saying that, though, Wade. For the variable expenses, if you have an increase or a change in volume, right, you're going to have an increase in variable expenses because you sold more units. So you have more in expense. So we're going to take 650 units sold times $300 per unit. The variable expense per unit. So instead of 150, we're actually going to have 195,000 in variable expenses, which is an increase of how much?
45.
45,000. For contribution margin, you could just subtract down, right? But the calculation that you would use, and you should use just to double check, 650 units sold times 180 per unit, which is our new contribution margin per unit. So our new contribution margin would be 117,000, an increase of 17,000. So notice we increase sales by 62. We subtract out the increase of variable expenses of 45, so equals the increase of 17. For fixed expenses, what are my fixed expenses? Is it still 80?
No, it's 95.
It's 95. It's an additional 15 because they told us. That 80 is still there, but we need to add in the additional 15 for advertising.
Where's the 80 on the screen?
It's what's given in the original information over here.
Where? Oh, okay.
Yeah. So that stays the same, but they have an increase of 15 for the advertising. So we're adding to that number. So we're subtracting fixed expenses from contribution margin. What is my new operating income expected to be? 22. For the change, we're looking at the 22,000 versus the 20,000. Also, we're subtracting down. We had an increase in contribution margin as well as an increase in fixed expenses. So we're subtracting those two, right? So it's going to increase by 2,000. That's what we're expecting.
And this would be approved, right?
Yeah. Technically, this would be accepted. And I have gotten the question in the past, is it enough to justify it? Maybe. If you had a different scenario that's projecting a higher increase in operating income, you're probably going to go with that one first. Because you know that you have this 20,000 solid right now. This is a possibility. It's a projection. So it might not come to fruition. And if it's that only that much of an increase, it might not be the right case to make. Questions for the income statement approach? For the incremental approach, we're only focusing on the changes, things that are changing. So first thing that we're going to look at is we're going to say new contribution margin. So it's the 180 per unit times 650 units sold. 117,000. We want the change in contribution margin, so we're netting out what we already have. We already have $200 per unit times 500 units sold. What were original set of information. We already have 100,000 in contribution margin.
So what you're doing right now is similar to like the income statement, like
It's
the document.
Yeah, so what I'm doing right now is it's just cutting out and focusing on the increases, the things that changed. You're not looking at sales, you're not looking at variable expenses, but rather you're looking at contribution margin. And the reason why we're showing the original contribution margin and the new contribution margin is because they already have 100,000 in contribution margin earned.
It is also
So-
kind of like comparing what it was in the past versus the latest one.
Correct, and we're just calculating the change. How much did it increase by
And
making
the less the original CM, would that come from the old document?
Yeah, it's over here.
Okay, I
So-
found it. Okay.
So this is going to be the increase in contribution margin, right? Of 17,000. And we're comparing the increase in contribution margin to what? Less the increase in fixed expenses. Right? We said that we need to have this advertising, this additional advertising. It costs 15,000, so it's going to increase our fixed expenses by 15,000. And then we net it to calculate the change. So the expected increase in profit or operating income,
Will it be 2,000?
2,000. Yep. So it calculates out the same to the same answer. It's just quicker.
This way is quicker?
Yeah, this way is definitely quicker. The next one I want you guys to do on your own. So it reverts back to the original set of information, but the scenario is slightly different. And I want you to try to do both approaches for this one. So did everybody get the incremental? Do you need me to go back to it?
I'm good.
Okay. For scenario 4, so I'll read it through, but I want you to try both on your own. What is the profit impact if RBC pays a $15 sales commission per bike sold instead of paying salespeople flat salaries that currently total $6,000 per month? An increase, and this is going to increase their unit sales from 500 to 575 bikes. So it's shifting costs from one type of cost to a different type of cost. So I want you to do the analysis for this one. Let me know if you have any questions too. Okay, it looks like some of you are still working on it. Is that right?
Yeah, still working.
Okay, perfect. Okay. Before we get into it, I was noticing while I was creating the test that the way that the book is doing the incremental approach is having you do it slightly different. Remember, I said that there are different ways of doing the incremental approach. For your test problems, write it out on a piece of paper, because if you do it correctly and you calculate the correct answer on that piece of paper and you show me how you calculated it, I will go back and correct your score for you. Does that make sense?
For
Because
the incremental approach.
yeah. So with all accounting programs and systems, we deal with IT people that don't understand accounting that are creating the programs, right? So they think that there's a certain order and there's a specific thing that needs to be answered in a specific box, and that's not always the case. So to be fair, I'll offer that to you. Does that make sense? For every single problem, just write out your steps and you can show me it and send it to me and I can correct it if you have it correctly done.
Sounds good.
Okay. For this scenario, that $15 sales commission, what is this? A change in selling price or a change in something else?
Tack it onto variable expense.
Variable expense.
Yeah, so we're going to see an increase in variable expenses, right? So we know that it's not going to be $300 per unit, but rather it's going to be $315 per unit. Increase of 15. We're not pushing it off to the customer. So they're still going to be charged $500 as their selling price, correct? if we have an increase in variable expenses and no change in our selling price, what happens to our contribution margin per unit? Decreases by the same amount, 15. So now it's not going to be $200 per unit that's earned, but rather only 185. What does it mean for our ratios? Is the variable expense ratio still 60%? No. And the contribution margin ratio is not 40%. It's changed as well. You can recalculate them, but I know for this one, it's going to come out to not an even percentage. You'll have some decimals, so I'm not even going to bother doing it. For this particular scenario, those salaries are going to decrease by $6,000 per month. What is that?
That's a reduction to the fixed expenses.
Yeah. So a decrease in fixed expenses. And then an increase in sales volume specifically. If they say and they give you a dollar amount that sales is going to increase by, and they did not tell you that there's going to be a change in the selling price, that means that it's an increase in volume.
It's just volume, yeah.
Yeah. So they would explicitly have to tell you if there's a change in selling price. Do you want me to do the incremental or the income statement approach first?
Income statement.
Okay. I want to start with the incremental next one though. For scenario 4, we have 500 units sold, right? And how much did you calculate for sales revenue?
287,500.
Yeah, 287,500. So do you need me to write it out or just say it?
You just say it.
Okay, so $500 per unit times the 575 units sold. For variable expenses, I will write this one out. It's $315 per unit times 575 units sold.
180,
How much?
125.
181, 125. So for our change column, sales revenue increased by 37,500, right? For variable expenses, it increased by 31,125. For contribution margin, how much was it per unit for the calculation?
106,375.
That's the total, sorry, but it was 185 per unit times 575 units sold, right? Your
Yeah.
calculation?
Yeah.
106,375. That's great. An increase of 6,375. And if I subtract it down, it would be the same increase. For fixed expenses, it went from 80,000 to what?
74,000.
Yeah, 74,000. A decrease of 6,000. $106,375 minus the 74 gives you a new operating income of what? 32?
32,375.
Sorry, 32,375. How many of you went over here and just did the calculation down and you got 375 as your change? Anybody?
No, I stopped there because it obviously isn't that.
Okay. So remember from math and remember this income statement. Contribution margin minus fixed expenses, right? Equals operating income. In all of the previous examples, our fixed expenses either didn't change or increased. So you can think of these increases as positive numbers and the decreases as negative numbers, right? So we have a positive increase, 6,375. And then we have a reduction in costs of 6,000. A reduction in cost is actually a benefit. Cost savings. So think of this as a double negative. You would go negative, negative. What happens when you have that double negative? It turns into a positive.
Positive.
So 6,375 plus the decrease of 6,000 is actually going to be an increase to our bottom line of 12,375. It's tricky on that one. If you had everything else correct in there and you just had this part incorrect, you would get the majority of the points for this problem. But this one is tricky. You just have to remember that if an expense decreases, then it's actually just, you're going to add that back. It's really hard explaining this without you guys being in class. I'm not going to lie. Trevor, you doing okay? Okay. For the incremental approach for this one, other than maybe this number, did you guys do okay on that?
Yep.
Okay. For the incremental approach, what did you do? Did you do it? Probably not.
Didn't get to it yet.
Okay. Do you want a minute to try to do the incremental approach?
Sure.
Okay. Don't worry, we're taking a break after this one.
Professor,
Yeah.
is this page on Canvas somewhere?
Which page?
The one with just the problems on it
The one with the problems, yes.
that you're doing right now. What section is it under?
It should be in the announcements. And it would be with the announcement for the last class.
Okay, thank you.
Yeah.
Yeah.
Okay, you guys ready?
Yep.
So you're looking at the new contribution margin. You could have calculated first the new sales revenue of 287,500. You could have calculated a new contribution margin ratio and multiplied that if you wanted to. Or you can just go back to the per unit, 185 per unit times 575 units sold under the new scenario. So that's where you get the 106,375. For the original contribution margin, I just showed you an alternative way of calculating it. So we have the 250,000 in sales. Of those 250,000 in sales, we know that 40 cents of that sale is contribution margin. So multiplying it times the contribution margin ratio and backing into the 100,000 that you already have. You're going to have an increase of 6,375. So an increase in contribution margin of 6,375. We know in this scenario that you're going to have a reduction in fixed expenses of 6,000. And again, you have basically a double negative. So you're going to add these two amounts up because you have an increase in contribution margin. That's a benefit. And a reduction in fixed expenses is also a benefit. So you add them together and you're going to see an increase in operating income of 12,375. And you would say accept. I think a lot of the homework problems are having you use the incremental approach. It is the better approach to use. You will get more comfortable with it. And the reason why it's the better one to use is because there's less places to make an error or a mistake in calculation. If you mess up calculating sales revenue, it's going to trickle down if you're using the income statement.
You're talking about the one on the Pearson, right? Or on here you're teaching us.
I'm talking in general. So in life itself too. Think about a spreadsheet. The more numbers that you have in a spreadsheet and the more I'm talking about for Excel, and then the more numbers or hard coding that you have where you've manually typed things in, the more potential for errors that you have. So,
I know this is probably like off the topic, you could say. I remember that in the beginning of the semester that you did say that you want to teach us how to use a spreadsheet on Excel.
not yet. We'll get there. It'll be the next chapter.
Oh, so we're still doing it.
I think so.
Okay, because I was curious about it.
Yeah. We'll talk more about this next class.
Sorry,
What was that?
I just got here.
Oh, no worries.
I didn't realize the number, the ID changed today. I was waiting for the other room forever.
Yeah, sorry. It always will change.
Oh, okay.
Yeah, so we don't get any hackers.
Oh, that does remind me. I came to Zoom a little bit late because I was trying to find the link that you were supposed to join the meeting. So I don't know. I actually got lost where you guys were. So
I'll always post it in the announcement either the day before the
always
morning.
new
no,
number
what I
right
mean
now.
is like when I came in late and when I finally found the link that you have on your announcement, when I decided to jump in with you and the other classmates, I have no idea where you are.
Yeah, sorry. So
No worries. I
the
came in
announcement
late. I
was
tried
gonna
to
have
find
the
it.
correct date, the correct link. So
Um,
and you can watch the recording. Okay.
True.
Professor Wade, I have a question.
Yeah.
Okay, so
Right.
the
There you go.
first thing we did was figure out the change based on the change in information.
Yeah.
Is there a quick way, and I'm sure there is, I'm just not seeing it, to take those changes and just simply plug them in to come up with the new?
Okay, so sometimes yes, but not always. So if you go back to, I think it was scenario one, you could do a shortcut way. But for a lot of them, because multiple variables are changing, you can't change it. It's not going to be an easy shortcut.
Okay.
So for instance, I can't just look at the increase in that variable expense and then just focus on the change in units sold, right?
Okay.
Because all 575 of those units now have an increase in variable expenses.
Okay, so I'm looking for something that's not there, right?
Correct.
Okay.
In some scenarios, it's like case by case. You have to look at it. So
Okay.
if your per unit information doesn't change whatsoever, then you can do that kind of jump.
Okay.
But a lot of the scenarios, selling price or variable expenses changes, so you can't.
Okay, cool.
Good question. Okay, we're gonna take 5 minutes here.
So wait, I have a question actually.
Yeah.
I'm not sure if I missed it or not, but on the increase in contribution margin and the decrease in fixed expenses,
Yeah.
how come you added them together and not subtracted them?
Okay. So we're always subtracting fixed expenses, right?
Yeah.
Always subtracting it from contribution margin.
Mhm.
In most of the cases, you either saw no change in fixed expenses or you saw a increase in fixed expenses. An
Okay.
increase in a fixed expense is a cost, right?
Mhm.
You have additional cost. When you decrease a fixed expense, it's a benefit.
Okay.
So a reduction in cost is actually a good thing. You want a reduction in cost.
Okay.
So
Cool.
you have a reduction in cost here, and then you have an increase in contribution margin, which is the excess of sales. So you have a benefit here too. So you're adding them together.
Okay. Thank you.
The other reason is because it's just math, double negative.
Yeah.
But that's really the reason from an accounting perspective. Okay, take 5.
Sorry, I'm sorry I disturb you. The question, something is a little bit, I'm just curious of. So the scenario that you, sorry, that's my husband. So the scenarios you're referring to is involved with the chart that you have on the handout.
Yeah, they're the same.
And so like, just like for notes and such, the total, is that for the 500 or
what total?
The total that you have on the handout, it says the sales as a 500 bikes, that's the 250K.
The original information?
Well, you have this on the chart. I'm not sure
Yeah, that's the original information.
So the total, that will be the 500.
Yeah. So it's $500 per unit at times 500 units sold.
And then the per unit, that will be the 575.
The $500, 300, and 200. The 575 is volume.
Oh.
I had a question.
Leah, does that make sense?
I believe so.
Okay.
I'm trying to adapt to this handsheet because I didn't see it before, but then I just printed it out.
Okay.
And I'm trying to understand it.
Okay, check it over and I'll talk. Kelvin, what's your question?
For the change in operating income, why is it 12,365? Why did you add it?
Because you have two benefits here. A decrease in fixed expenses is a benefit. You want a reduction in costs.
Okay.
An increase in contribution margin is also a benefit. And the other reason is because you're subtracting, right? Subtract, and technically if that's a decrease, it's a decrease in negative number.
So you're turning that to a positive. Yeah. So usually as a kind of as a note, I guess you could, as a rule of thumb, if there's a decrease in the fixed expenses, you're adding it to the Correct. Contribution margin.
Absolutely, okay. Yep.
Rule of thumb. Got it.
Yeah, you can definitely keep that as a rule.
All right.
Brad, I don't know if you're still on, but I also like Wade's beach scene behind him. I'm trying to figure out if I can do it.
Yeah, I took that at OB one day, and I just came across it the other day, because we've had all the time on our hands.
Well, I know you can do the green screen like thing behind it, but I don't know where. I think it's outside of the, to figure out how to do it and do it for next class.
Yeah, I think I did it before it threw me out of our meeting. And that allowed me to, browse and find that photo.
It's perfect. So it makes you feel like you're at the beach. It's pleasant. Thank you.
Right, I wish I was.
Uh-huh. If only we could go. I can't believe they're trying to keep Southern Californians away from the beach. It makes sense why, but
I still see a lot of people go to the beach or people doing social activities outside. And I heard on the news that the government recommend if people are going to go outside, they should have something to cover
their face,
like a scarf, or just avoid physical contact, because anything can go in our mouths. But nobody doesn't do that, or I should say hardly.
There's a lot of people in my neighborhood are doing it. Oh, thank you, Samantha, to figure out. Was it in here though? Like in the recording, or no, it's outside of it?
Sorry, did you do scenario 3 and 4 so far?
Yeah, today. And then we'll do 5 and then we'll move from this.
Okay. I'll have to go back to 3 and 4 later.
So the sales revenue and the variable expense, like the 500 and the 300, are given?
Yes, we had done that before.
Oh, like last class?
Yeah.
Okay.
So if you want to know how to calculate it, I can write it up here.
Okay, cool. Thank you.
So you take the total for sales, for instance, total sales, divided by number of units sold.
Okay.
Okay, 500 units sold. And that's $500 per unit, the selling price per unit. For the variable expenses, you would do the same, the 150,000 per unit, or sorry, 150,000 total, divided by 500 units sold. And that gave you the $300 per unit. And same for contribution margin.
Okay, thank you.
So those first 3 numbers, you can do it that way.
Okay.
Fixed expenses, you shouldn't.
So Professor Wade,
Yeah.
so once we come up with the new contribution margin,
Mhm.
we can immediately jump to the incremental approach. That's what you're trying to get us to do, right?
Yeah.
So then we do the new contribution margin less the old contribution margin, and we can just work down from there. And it's always going to be in the same order, but different, it'll vary on whether contribution margin increases or decrease. And,
Correct.
okay. All right, cool.
Typically what you're going to see is that contribution margin typically does increase. There are scenarios where it doesn't, but it's usually you're gonna have it.
Why would you want to take an approach that's going to decrease your contribution margin, right?
True, exactly. Except for if that decrease is less than the decrease in fixed expenses, then it's still going to increase your bottom line. But yeah, usually you're not going to want to decrease it.
Maybe a firestorm or a fire sale?
Yeah, well, I mean, yes. And that's where it's like the loss leaders and kind of thinking about that. Getting people into the store to buy other things, etc. There's theories behind it, and that's more of like a marketing class, but this gives you kind of the numbers side of it.
You know, I was thinking about that. The one chapter talks a lot about, I think it was chapter 4, talks a lot about, you know, JIT production. And I've worked in that environment before. And
yeah.
Yeah, so these folks that have switched their distilleries over to hand sanitizers, I'm going to say one of the big reasons why they were able to make that transition so smoothly, not just because they already have a distillery,
yeah.
but because they're operating under the ideas that were reviewed in chapter 4. You know, they have JIT, so they don't have a whole lot of stock on hand, so they're making the transition over to a new product is much less difficult.
Yeah, that's a good point. I mean, especially because beer, it makes sense. It expires. And those small like companies, those distilleries and alcohol companies, sales or production companies, they can't just have a whole bunch of stock. And a lot of them are operating on thinner margins. So keeping costs down is important. But I think it's awesome that they've been able to. I think the other problem though, it's like a benefit and a detriment. Like some right now, especially like 3M, you were hoping that they weren't operating just in time.
Yeah, right. And I think that could be, you know, like I think what might offset the benefits of JIT would be, say, like if they had contracts, you know, where their contract would cover the cost of storage and warehousing.
Yes.
So like if they would do, some of it would be JIT, you know, like to their, you know, their retailers and things like that. But then they have contracts that would, make up for the difference for, you know, warehousing and things like that. Yeah.
They're going to have to figure something out, especially for like medical supplies. I don't think that they're going to let this thing happen like it is right now. But you're right about the cost part. Who's going to take it? Is it going to be the manufacturers? Because they probably can't afford it.
So, you know, you're aware that like 2 years ago, a Netflix program came out entitled Pandemic.
Yes.
Yeah, that predicted this.
Okay, so my mom's an infection preventionist. So she actually gave me a book about it. Epidemiologists have been predicting this for a while. They don't know what it was going to be, but yeah.
So when they come with all that, you know, how are we supposed to know stuff?
Okay, the profit part.
Well, you know, they have a program about that on Netflix.
I know. Well, the whole thing is like, it goes back to profit and the focus on profit for a lot of companies, and including hospitals, and keeping costs down and profit up, you know? So it's like, that's why accounting is so relevant. you know, you couldn't, if epidemiologists are predicting but their bottom line, they're focusing on the bottom line. And I know that a lot of hospitals are operating at a thin margin.
Yeah, they do. You're right. Absolutely.
And right now, a lot of them are hurting because they had to cancel elective surgeries, which bring in a lot of cash flow and also revenue. So it's hard. It's like there's so many variables to it.
It gets complex real quick.
Yeah, but we can chat more about this in a little bit. Are you guys ready to keep going? Yes?
Yes.
Okay. But see, telling you, accounting is relevant to your life.
I would start making the mask myself. Then I would start thinking about direct materials and labors.
Yeah, because if you want to sell it, you need to know how much your costs are. And then check to see if
I didn't count the labor, but yeah, I was thinking counting labor and direct materials.
Well, and I'm trying to either redevelop or find a better budgeting that's more relevant for right now for your project. So to be determined. Okay, the last scenario is a little different. And it's kind of an introduction to special orders. So if RBC has an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses, what price would it quote to the wholesaler if it wants to increase monthly profits by 3,000? So I kind of want you to think about this and think about how you would come up with this. There are different ways of calculating it. You're not going to be able to, or you're not going to want to necessarily recreate the income statement for this one. But try to figure this out. This is considered a special order. So certain things that are relevant under normal circumstances are not relevant in these sorts of circumstances.
So is the question going to be what percentage are we going to have to increase our contribution margin to have it affect operating income?
No, you're trying to figure out, you're backing into this, the price that you're going to charge. So what price, and you could do it the contribution wise, you could take that approach, but you're trying to back into the price that you want to charge to get the increase in your bottom line.
Right, okay.
So you're still selling 500 units at the original. So you still have this. It's not disrupting what you already have. But we have capacity and we want to increase our profit.
But without changing the fixed expenses.
Yeah, because that's what it says.
The cost of the bike is still the same as the previous. To the other.
I'm not going to. Oh, the cost, yeah. Unless it tells you otherwise, then yes, it is.
Okay.
And Jacob, too high.
So, restoration of myself. Okay.
Okay. So something that you should understand about special orders in general, unless it states otherwise, fixed expenses are typically irrelevant to the decision because they don't change.
What was the cost of the bikes?
Wait, we're getting there. For this special order and with every special order, you're focusing on what actually is incurred to make the bikes, right? So do they have 150 bikes on hand above and beyond what they currently sell?
No.
No. So that means that we have to produce an additional 150 bikes, right?
Yeah.
So are we going to say, hey, here's a special order. The selling price is going to be $500 per unit?
No.
No. With the special order, the original selling price is irrelevant. None of your other customers find out about this. This is a one-time offer with this customer. It's going to you're just focusing on increasing your bottom line. So you're willing and able to accept a lower selling price. And part of it is because there is no change in those fixed costs, right?
Right.
So we don't have to cover those fixed costs with our selling price that we're charging. But if I was to just say, hey, calculate how much the profit is per unit, is that the price that I can charge them? It probably isn't. So first thing that you want to try to do is calculate this profit on a per unit basis. So the target profit desired, or the increase in your target profit, if you want to think about it, they're hoping to make $3,000 on this job, right? And we're going to divide it by the number of units in the special order.
So the 3,000, that's the total for all bikes, or is it for each?
For the 150, the total for this job.
Oh.
Yeah. So
I
per
just thought-
bike, what's the profit per bike?
$20 per bike.
Yeah. So can I say, hey, just pay me 20 bucks per bike and that's all, and it's going to increase my bottom line by that much? Is that right? If I just have 3,000 here, right? Is it going to have a $3,000 profit for the special order?
No.
You have variable costs.
Yeah.
Variable costs.
So we need to say, okay, yeah, 3,000 is the total profit we want to have. We want to increase our bottom line by 3,000. So 23,000 total. What do I need to do with the 20 and the variable expenses? because I have to create these bikes. I'm going to incur variable costs. So that $300 per unit,
You added to the 20?
yep, needs to be added
Mhm.
because we're going to incur that cost. So my selling price, I'm going to back into it. Selling price per bike is going to be $320 in order to ensure a profit of $3,000.
So for the goal to get $3,000, so that's only for 1 month.
This is just for one job.
One job.
Yeah, it's a one-time thing. It's not going to happen again. So special order, you could even test it out here. You would have for sales for the special order, it would be 150 units times 320, right?
So would you call this special edition? Let's say limited edition.
No, it's just a special order.
Oh.
So for that special order, it would be an additional 48,000, right? In revenue. So the total revenue would be 298. $250 plus the 48. For the variable expenses, it would be the total, right? So 650 units times $300 per unit.
Was that your basement?
Me? No. So how much is this going to increase by? It's going to go from 150 to 195.
20 times 500.
An additional 45. When I subtract down, now it's 103, right? An increase of 3 in contribution margin. Fixed expenses are still 80, no change. So now I have profit of 23,000, an increase of 3,000. This is not required right here. It's just showing you that it does calculate out correctly. So the important part with the special order is you're focusing on what's changing, right? Variable expenses are obviously going to change. You have additional units that have to be made, so you're going to incur additional variable expense. And then you can kind of back into the profit that you want based on this calculation, just adding the profit that you're desiring per unit to the variable costs per unit to back into a selling price that you want to accept. If you were to accept $300 as a selling price, your bottom line wouldn't change at all. But if you accepted less than $300 per unit, what would happen to your bottom line? Even though you sold more units, your bottom line would actually decrease. If you sold it for under 320, or sorry, under 300.
Where'd you get the 195 from? You had the 150 and then you just added the 48?
195, no, so 650 units times $300 per unit. Yeah. I just ran out of space, sorry. This chapter is not the easiest to use this in. I'm sorry.
Just 7?
What?
Just 7?
Chapter 7?
Yeah.
Yeah.
Or is there more that's going to be a little bit more complicated?
No. It's not complicated. It's just how it's set up.
Oh.
Okay. In the handout, there's a lot of practice problems that that you can do on your own. And the answers are in the PowerPoint that I'll post up there so you can look through it. All of those coffee clatch ones that you see in the handout are practice for you. And
Where is
in
the handout?
It's in the announcements from last time. You don't need it right now, but if you want to look through it, you can also see it in the PowerPoints too when I post it. The rest of this chapter is really just calculations that you can do and use to figure out different things and different information. So we don't have to create an income statement every single time we want to figure out where the break-even point is. That would be ridiculous. We can, but that's just ridiculous. So we're just going to go through the calculations and then you guys will be on your way today. Okay. So we're still going to use Racing Bicycle and the set of information for Racing Bicycle. So what I just did was I just copied it down here. So you have it. Okay. Remember that the break-even point is where profit equals 0. So the level of sales in total sales dollars or units sold where you don't have a loss and you don't have profit. You exactly cover your variable expenses and your fixed expenses. This is important. We want to know what our break-even point is so that we know if we can cover our costs each month, how much in sales we need to make to cover those costs. So you can express the break-even point in total sales dollars and the break-even point in unit sales, and there's 2 calculations. For total sales dollars, and for both of them, what do we always have to cover each month regardless of units sold?
Fixed expenses.
Fixed expenses.
Fixed expenses. They're always there. They're not going away. We always have to cover these. If I don't make $80,000 in sales, I will not have a profit. I will be operating at a loss. So fixed expenses is always on the top because we have to cover those each month. So fixed expenses divided by, if I'm trying to calculate total sales dollars to break even, so sales revenue to break even, I'm going to divide that by the contribution margin ratio.
What are we looking for? Sales in dollars?
Yeah, so this is sales in dollars. So how much in sales do we have to have to break even? And we're using the contribution margin ratio because it's a percentage. Dollars divided by a percent equals dollars. So for fixed expenses, we know that this company has $80,000 in fixed expenses. The contribution margin ratio, and remember that we calculated it by taking either total contribution divided by total sales or the per unit set of information. So we're taking contribution margin divided by sales. And it equaled 40%. So for every $1 of sales, 40 cents of that dollar went to covering fixed expenses and adding to our bottom line. So 80,000 divided by 40%. Remember that's 0.40 equals
200,000.
200,000. So when we sell $200,000 worth of goods, we have covered exactly our fixed expenses and variable expenses. No profit, no loss. And I'll get to that in a second. For the break even in unit sales, we're still calculating break even. So we're still keeping fixed expenses on the top because we have to cover them. And this time now we want the number of units that we have to sell to break even. So what we need to do is divide this by the contribution margin per unit. So how much in contribution margin are we earning for every unit that we sell? So we take our 80,000 in fixed costs divided by $200 per unit in contribution margin. And when we do this, we're eliminating the dollars, right? And we're left with units. So $80,000 divided by $200 per unit, dollars eliminate, and we calculate how many units to break even.
400.
400. Is there a way to check your work? Yes. The answer is yes. So if I take 400 units to break even times the selling price, $500 per unit, that equals total sales to break even. So it's just a check. I could also take that total sales dollars to break even divided by the selling price per unit and back into the number of units to break even. You don't have to do the check 100 times. I don't even have to recreate the income statement because we already did that before. Did we already create the income statement for 400 units sold? Last class? At the beginning of last class, we actually created the income statement for 400 units sold.
Yeah.
And we know that that is the break-even point. Yeah. Is this much quicker than doing that?
Yeah, it's much quicker.
Yeah, it's much quicker. The one thing is if you are going to use the shortcuts over here, keep in mind that if you rounded this at all, it won't come out exactly the same. Does that make sense?
Yes.
Okay. The next part we're just going to go through is a multi-product break-even. So this one's slightly more complicated. It's not much though. And there is a practice problem for you for the break-even point that you can do on your own. For, my notes got messed up, sorry. There we go. For the multi-product break-even, this is going to be more common for most companies. Most companies sell more than one product. Each of the products that they sell typically has a different selling price, different variable expenses associated with it. So they have different contribution margin that's earned from each of them. With multiple products, you have to take into consideration those individual contribution margins for each of those product lines, but also the relative sales percentage. So in this example, and you're going to want to, I don't know if I gave you that in the handout, but we have two different product lines now, bikes and then carts.
Yeah, you did. It's in
Okay,
there.
perfect. So you don't have to rewrite it. For this company, bikes represent 45% of their total sales. So the 250 divided by 550,000. And carts are 55% of total sales. 300,000 divided by 550,000. For bikes, and notice that right here we have, this is basically a segmented income statement. A little bit less than a whole segmented, but it's good enough. And for each of the segments or product lines that we have for bikes and carts, we stop at the contribution margin. We want to keep the fixed expenses just in the total column because we only care about the total. For bikes, bikes has a contribution margin ratio of 40%. For carts, carts has a contribution margin ratio of 55%. The weighted average contribution margin ratio is 48.2%. Okay, so because bikes is 45% of the sales mix, it's going to have less weight towards that 40% because the carts has a higher contribution margin ratio and has more units and percentage of the sales mix. It's going to be a little bit higher and skewed towards the 55%. So the calculation to get that 48.2 was just taking the 45% of the sales mix for bikes times the contribution margin ratio for bikes and then you're calculating that out by multiplying the 45% times the 40% contribution margin ratio to get that relative percentage. And then you're taking the sales mix for carts, 55%, times the contribution margin ratio for carts. And it comes out to 48.2% as the weighted average contribution margin. For break-even point in a multi-product company, you're kind of doing a similar calculation first. You're taking the fixed expenses divided by the weighted average contribution margin ratio. So $170,000 in fixed expenses have to be covered by the company, divided by 48.2% for that weighted average contribution margin. It's going to come out to not a pretty number, right? It's not a pretty round number.
Because of the extra because there's a decimal in the percentage, the 48.2%.
Yeah, and just 48 is not a pretty number either.
Just 48.
Yeah, 48.2 is not a pretty number. That's why. It's not round. It's not 50%. It's not 30%. It's, yeah.
Do most companies usually round these percentage try to get as close to? No?
No, you're not going to round it.
In the business world, do they usually round the percentage usually? But
No.
for this one, no.
You're going to round it, but I mean, computers are doing this stuff too, so there might not be even that much rounding. It really depends. But if they're using a computer system to do all these calculations, there's not going to be the rounding because it can go off into the.
Basically, like you just put it in like the I'm not sure the coding is the right word, but the equations in the Excel with that so it just automatically you just put in the amount in it and then it will calculate what's going to be with the percentage.
Yeah, you program all of it. So it calculates it. You don't even put the numbers. You just link it to things. If you're using Excel, you're just linking it to specific cells and telling it how to calculate. But if you're doing it from a computer program, it's coding.
Yeah, so it is basically just coding.
Mm-hmm. So
Professor
yeah.
Wade, I'm a little bit lost. When you calculated the sales mix over there, times the contribution margin ratio, and then the sales mix and the contribution margin ratio for bikes and carts.
Yeah.
I'm having trouble coming up with where you got, I'm looking at the chart here and you have the sales mix for bikes. You have 45% times 40%.
Yeah.
Where are you getting the 45%?
The 45% is a sales mix percentage. So
that's a 3. Sorry. It kind of looks like a 3, just missed the stem connected.
yeah, that's 45%. You see it now, Wade?
I see the contribution margin ratio in this table right here.
Mm-hmm.
For bikes, which is 40%. I'm not seeing the sales mix.
Up at the top. So $250,000.
Okay, thank you.
Yeah. Okay, so you calculated 352,697 roughly. So the company overall needs to have sales of 352,697 to break even. Then you have to take it a step further. So total sales to break even. $352,697. And what you're going to do is multiply that times the 45% of sales is bikes. So to figure out how much in sales to break even per product line. So 352,697 times 45% for bikes, because that's the percentage of the sales mix that bikes represents. And of that 352,697, 158,714 is what needs to be earned to break even. For carts, we have to sell $193,983 worth of carts to break even. Does this calculate out exactly to the break even point? No, because of the rounding up here at the 48.2, it's slightly off. It's slightly higher than the break even point, but this is as close as you're going to get. And that's okay.
So again, on the exam, if we submit our work to you, you will consider that, right?
Yeah, absolutely. And on the exam, follow the rounding. They'll tell you in the homework too, follow the rounding that they tell you. Because each problem is a little bit different in how they want you to round.
So the 48.2%, that's not rounding.
It may be. The 0.2 is probably rounded.
It's 48.25.
Yeah. See?
It would be 48.3.
Could be 48.3. It probably technically should be 48.3. If it's 48.25. Okay. What was that?
Now I'm curious. I want to see if it is true. It's supposed to be 3, not 2.
Use it off. Sorry. If it is, and I'll change it for going forward. Okay. For the next part, target profit is, if you understand how to calculate break even, it's really easy. Target profit is a desired profit that the company hopes to achieve. So we can say, how much in total sales do we need to earn to reach $50,000 in profit? So how much to reach 50,000 in bottom line? Or how many units do I need to sell to make $100,000 in profit? You think about it, the break-even point, what was the target profit for the break-even point?
0.
0. So essentially calculating break-even is fixed expenses plus 0 of a target profit. Where the target profit in sales dollars, we still have to cover our fixed expenses. And we're going to add in our desired target profit. Because we need to cover our fixed expenses, plus we need to achieve that target profit above and beyond those fixed expenses. And we're going to divide it again by the contribution margin
Ratio.
Yeah. So suppose RBC wants to earn a target profit of 100,000. So we still have fixed expenses of 80,000. We're going to add in that desired target profit of 100,000. So 180,000, if you will. Divided by the contribution margin ratio, which is still 40% sales. So in order to achieve that target profit of 100,000, how much do my sales need to be? What's 180 divided by 40%?
450,000.
Yeah. 450,000.
Oh,
So we currently have $250,000, right, in sales. They have profit of 20,000. So you know it has to be higher than 250 because the profit is 5 times higher than what we currently have. It's just kind of a logic check. For target profit in unit sales, you still have to cover your fixed expenses and add that desired target profit. And not desired toilet paper, but target profit. Sorry, I had to do it this time.
It kind of looks like the word toothpaste.
Well, I never would be for adding desired toilet paper, but apparently.
My friend bring me a vegetable today, and I'm paying her with the toilet paper. Seriously.
Oh gosh, it's so bad. Okay, so divided by what now? Contribution margin per unit. Yeah.
Margin per unit.
Yeah.
Oh yeah, because it says unit sale.
Yep. So again, you take the 80,000 plus 100,000 right?
So then it'll be divided by 200.
Yeah. And this is why I said this chapter and then going into the next few chapters, you want to label everything so then you kind of understand where it's coming from. So you know that it's not the ratio that you want here because you want to end up in units. So $200 per unit is on the bottom.
No, your answer's in units.
Then
Yeah.
it'll be 900 each.
Correct. So 900 units. So it's the dollars are going to eliminate here, dollars and dollars, and you're left with units. 900 units need to be sold.
Oh, I didn't realize what I said. Whoops.
So it's okay. For the check, you can do the check again. 900 units sold times the selling price. $500 per unit is going to equal
The 450,000.
yeah, the sales dollars. It's just a check for you to make sure you calculated it correctly. You don't have to do it. Okay. So are these a lot easier than CVP?
Yeah.
A little bit.
Yeah. So I think that part of it is just how our education process is in lower levels. Like they don't give you a lot of things that you can't just get the right answer or take one approach to it. But in this class, especially with those CVP analysis, it's a lot more critical thinking to it and kind of thinking about and figuring out the puzzle pieces to it. So it is going to be a little bit trickier at first, but you'll catch on to it the more you do it. And it's fun. That CVP analysis and using it is really going to be beneficial to your careers. Personal life, if you want to run a business, anything. It's really important to understand like how it works. Especially marketing majors. I know a lot of people like marketing.
Who doesn't?
I thought it was an interesting class, but I was not good at it.
Oh.
It's not my
It's okay. It's all about practices.
But okay, for the last two things, they're just super easy calculations. Margin of safety is just telling you how close you are to operating at a loss. So how much above the break-even point are you? How much in sales can you lose, or number of units sold can you lose before you start operating at a loss? So you can express it in a couple different ways, but margin of safety is in general total sales, what you currently have in sales minus break-even sales. So I wrote out the break-even point for all of us, so we have it here. And we'll first calculate it in dollar sales.
You're talking about the green penmanship or the blue one?
Green.
Okay.
Actually, wait, go like that, sorry.
So the chart about the 500 bicycles, is that carried out throughout the entire packet?
Yes.
Just for the exercise?
Yeah.
Okay.
Okay, so you're comparing your current level of sales, what you currently have, to the break-even point. So they currently have $250,000 in sales during the month of June. Break-even sales is 200,000. So the margin of safety is expressed in sales dollars is 50,000. So we could lose up to $50,000 in sales and still not operate at a loss. If we lost more than $50,000 in sales, we would be operating at a loss. If we reduce sales by exactly 50,000, we would break even. Does that make sense? So
Is
it's
that going the
pushing,
same with the
basically.
increase?
Yeah. We were looking at it differently when we were talking about increase. This is now saying, okay, if we lost this, or if we lost any of our sales, how much could we lose before we start operating at a loss?
Oh.
That's all this is doing. So it's just a quick calculation. I don't think it's that difficult. You can also express it in unit sales. So how close are you to operating at a loss? How many units could you lose in sales? And we're currently have 500 units sold. And we break even when we sell 400 units. So we could lose up to 100 units in sales and still have a profit. That's my dog. If we lost exactly 100 units in sales, we would operate at our break-even point. If we lost more than 100 units of sales, then we would operate at a loss.
Professor Wade, can you make a traditional income statement a contribution margin income statement?
Yes, you probably can't though, because you're looking at the financial statements for externally provided financial statements.
So it's possible, yeah?
It would be hard to do. So the reason why you don't see the contribution income statement in the segmented income or certain parts of the publicly traded companies is because they probably don't use it internally intentionally. If they used it internally, they would have to disclose it. You don't want your competitors to know what costs are fixed for you and what you have to cover for fixed costs. You don't want them to know what your variable costs are. It's sensitive information. You can kind of calculate it, but every company is going to be a little bit different.
What I quite got from the previous chapter, chapter 6, was so contribution margin will be most likely affected through comparing, for example, inventories.
Yeah.
So variable cost for inventories.
Manufacturers.
Yeah, and absorption cost as well.
But you don't know what portion of their product costs are fixed. You don't know what portion of their selling and admin expenses are fixed. That's the hard part to know externally. Okay. Internally, all this information is there. They have it. The margin of safety as a percentage is probably more helpful too. So you can take either the units, margin of safety in units, or you can take the margin of safety in dollars. Either one's going to work. And you take the margin of safety and then you're going to divide it into your current sales level. So 50,000 is our margin of safety. Ooh, comma. And we currently have $250,000 in sales. So if we lost 50,000 of those sales, then our margin of safety is 20% reduction. $100 units divided by 500 units, 20% is the margin of safety. So that's basically your cushion before you're operating at a loss. Okay. For the last part, and I know this is really exciting stuff. Operating leverage is telling us how sensitive our operating is to changes in sales. So you can kind of figure out and back into how much your bottom line is going to increase based on a percentage increase in sales. The closer that the company is operating, the closer you are to the break-even point, the more of an increase or impact you'll have on the bottom line. The further away you are from your break-even point, the less impact you're going to have on the bottom line. So it's not a percentage that's going to stay the same. Degree of operating leverage is not going to stay the same. For the degree of operating leverage, you're taking your contribution margin, so that's obviously your total contribution margin, divided by your operating income. So $100,000 is my contribution margin currently, and my profit currently is 20,000 here. So my degree of operating leverage is 5. For the part that's really important is you're looking at the percentage increase. What happens if you have a 10% increase in sales? How is that going to impact the company's bottom line? How much is the bottom line going to increase by? So you take your percentage increase, 10% increase in sales, and you multiply that times the degree of operating leverage of 5. 10% increase in sales is not that much.
Going to give you a 15% increase in your operating income, correct?
Multiply, not add. 50.
Okay.
So that relatively small increase in sales can have a dramatic increase in your bottom line. And that's because we are operating somewhat close to our break-even point. We're only 100 units away from our break-even point.
So our operating income would jump to 30,000, right?
Yeah, exactly. And you can even test it out because the 550 units would be the total units that you would sell. You can multiply it times and calculate out, and it will come out to the 30,000. It does work. The thing to keep in mind is this degree of operating leverage does change. When we increase sales, it's going to change. And it's actually going to have less impact on the bottom line. But can you see how a small percentage increase in sales is helping the bottom line a lot?
Yeah, so if you just sold 10 more units, I mean, who can't sell it, right? I mean, that's kind of like, yeah.
And that's where you see like that push at year end to get those additional units sold, to get those additional services provided so that you can bump your bottom line. Because those fixed expenses are already there. Now we're just adding to our bottom line. Okay, that's all I have for this chapter. I'm 10 minutes early, yay. Okay, you have the handout so you can practice additional problems. Your chapter 7 homework, I want you guys to do it by by the weekend. But next class, what we'll do is we'll do a exam review, but your exam won't be until the following Saturday. Is that okay?
Perfect.
Not going to be on the 11th?
It'll be on the weekend. I'm gonna make it on the following Saturday just so you have extra time.
Cool.
It'll
I
be
noticed-
available for you to do it early.
Yeah, I noticed it says it's going to be due on 11th.
Yeah, I don't have the calendar in front of me. It's wrong. If it says the 11th, it's not correct.
The 18th?
But
Yeah,
we can still like get into it if it's like not like has to do or
What was that?
I guess like comparing to like the last semester, but for this one, we can still do it even though it's not like it's over the due or you had to do it on the due.
You can do it anytime before the due date.
So I have a question about preparing for the exam. I know you just said we're going to go over it Wednesday. Thank you.
Yeah.
If we go through in the chapter resources and take the pre and post tests, would you say that that's a fair test prep?
I would say the study plan is better.
Okay. Okay.
I haven't reviewed the pre and post tests recently, but I don't think that there's as problem based.
Okay.
It will be problem based just like my normal tests are.
Okay.
So, and because there's so many different kind of smaller topics in this one, and it is similar to the tests that I would give you in class, there's 7 problems. So there's different points associated with the different types of problems. The ones that are easier are obviously less points. But
Okay.
yeah, you'll know exactly what to expect. And
So are you gonna post the I'm not sure document is the right word, but for the last exam you posted what questions is going to be on the exam. Are you gonna do that again?
so I'll make an extra credit so you have practice problems that are similar, just like I usually do. If I have time, I will make a Word document that gives you it pretty detailed. But what was that?
I'm not sure. You gonna give like specifics of what's going to be on the exam?
I'll tell you, yes. So I will tell you exactly what problems will be on the exam. I can already do that right now. But because the problems are slightly different in the format that you're getting it online, I need to go through and kind of say, this is the steps that you have to do. And I don't know if I'll have time to do that in a Word document, but I will have it written down to give you.
Okay.
So you'll know what you have to do for the exam.
I have a question about the problems that you just did a while ago. Is about the multi produce products it's a multi break even analyst.
Yeah.
That part that you mentioned that there is a bike versus carts.
Yeah.
Is it just like I guess you could say is a general question. For a multi-product, can it be like not in the same categories? Like for example, Target, they have clothes, but they also have like food sections.
Well, each of those is going to have a different cost associated with it. They could do an average.
Oh, can that be an example as a multi-product?
Yeah, so most companies are multi-product. It just means that they sell more than one type of product that have different sales price and cost bases, which is pretty common.
Because the reason why I asked this question is because like the bike and cart, they kind of like go in this somewhat the same categories because they have like in common.
I wouldn't say because they have a different selling price per unit. They're going to have a different, you can tell even that it has a different variable cost per unit. Because one, for every unit that's made, 60 cents of it is going towards variable costs. So the other one only has 45 cents for every unit that's made, or every sales dollar that you make. So you're making more from those carts. you have more, you have less variable expenses, so you have more profit from those carts than you do from those bikes.
So would the cart, would that would the cart be a little bit more expensive than the bike then?
Probably. We're going to talk about that in a later chapter where we're kind of like focusing, and we'll look at supplies that are not in stock, so you don't have unlimited supply of something, and figuring out which one to focus your energy on for making the most profit for the company. But carts would probably have a higher selling price, but it depends on a lot of factors. If it's in a competitive industry and the competitors have a lower price, you might not be able to have a higher price that you want to have, even though you have a higher cost associated with it. But in this particular case, it looks like they have no problem with the price because you have 55% of every sale going towards profit and covering your fixed expenses.
You mentioned competitors. I remember that in person in class before the college closed because of the virus. I remember that we personally talked about like the demands of, say, for example, the toilet paper that people decide to order online versus in store, because like in stores they always like sold out versus the online. And I did remember that they all have a different selling price.
If you're thinking about Amazon and they're looking at third parties, they can set their prices whatever they want, and a lot of them are gouging. If you look at certain things, like it's like 4 times the price of a normal thing. For instance, I was looking for yeast for cooking, making bread, whatever, and people are charging $20 for the $5 thing that you can go into Target for. But I don't want to go into Target for yeast. I don't know if they're going to have it, and I don't want to go to 100 stores right now. So, and I refuse to pay $20 because that's 4 times the normal price. But yeah, that's illegal. That's price gouging. But some of them possibly are pushing off some of the additional costs. When you have to run operations 24/7 and your operations are not normally 24/7, just to get these products out there, you probably have a higher cost basis associated with that additional operating costs that you can and maybe are pushing off too.
But it's not going to be, the percentage.
It's not going to be a dramatic percentage.
Right.
Absolutely not.
I have another question. I don't know if it was in the book or YouTube or where, but it talked about places, let's say Walmart, that their weighted average is expressed in their sales because, their sales make up all the different components of their sales mix.
Yeah.
So I kind of was